Step into the fascinating realm of industrial metals, where steel prices fluctuate and market indicators are the pulse of an ever-evolving industry. Welcome to Cup of Joe, the metal podcast paying homage to our founder, Joseph T. Ryerson. Settle in, savor a cup of Joe, and let the conversation begin.
Hello, everybody. Welcome into September. Here in Chicago, we're starting to get ready for winter, and we're actually going to talk about a long, harsh winter, but for not related to the weather pretty soon, but momentarily. But now the newly married Nick Webb, as always, joins me. Nick, congratulations, sir.
Mike, thank you very much. And I apologize to all of our avid viewers for delaying this Cup of Joe by 1 week. I know I got a lot of messages asking, where the heck is it? And unfortunately, selfish me, I'm afraid my wedding would have been very short-lived if I was trying to do Cup of Joe from wine country.
Yeah, like right in the middle of your wine tasting tour.
Yeah, it probably would have been a little questionable for the career as well if I was doing it with a glass of wine in my hand.
Krista, right? Because Krista is your wife. So she's married to a celebrity now. She like that? She
yeah, I think she's been prepping for that for a couple of years now.
Yeah. Okay. All right. Well, we've got a lot to talk about. Feels like it's been forever. In the interim, we had a special episode with Chris Lyons from North American Stainless where we talked about what goes into lead times. So if you missed that one, it's on our YouTube page, all the podcasting platforms, like always. As always, shoot us your questions down there, and we're going to answer them along the way. But we got some stuff to go through, Nick.
We got a lot of new content. In the spirit of the new wedding for myself, I wanted to cover, have a little bit of fun around metals, specifically as it relates to wedding jewelry. I actually was kind of curious as I've been going through all the jewelry purchasing, how does it all work? How are these metals made? Just purely from a curiosity standpoint, I found some of these facts actually kind of interesting. And obviously there in the middle of your page, you've got Gold Member from Austin Powers, who clearly has a bias to the color on the left. But I found these facts kind of interesting. On the gold side, ultimately, I think many of us know that gold is measured in carats. You've got 24 karat gold, but I was curious where that came from. I guess way back in the day, medieval coins, there was this medieval coin that was pure gold, and it weighed exactly 24 carats, and that's how they determined that was going to be the purest content of gold. But what's interesting is, and maybe not many people know this, but when you start getting into things like 18 karat gold, 14 karat gold, and some of these lower numerical figures, those are actually percentages or fractions rather, as it relates to that 24. So if you've got 14 karat gold, that's 58.3% purity of gold content. 18 karat is 75% purity of gold content. Now, the whole purpose of that is, in both the case of gold and silver, in their pure forms, they're actually very malleable and very soft metals. So if we were to try and use them as jewelry, we'd probably ruin them within a couple of weeks because they are so soft. So in a lot of cases, in both silver and gold, alloys are added, things like copper, zinc, silver, platinum, which can change the color of those things. In the case of silver being added, that's how you get white gold. In the case of copper, that's if you have a high enough concentration, that can create rose gold. And then interestingly, on the other side, you've got silver, and you can kind of see it within the band very finely. If you've got the visuals up, it says S925, and that's actually the quality of sterling silver. So the silver measurements actually go on a fineness scale, and this fineness scale is measured in terms of 1,000 being the most pure. So 925 S925 is going to be 92.5% purity. So that's 92.5% silver. And then the remaining items are going to be things like copper and nickel. And interestingly, there are apparently actually people out there who have some allergic reactions to some of these alloys that get put into metals. So do your research if you're in the market for any jewelry. And but I thought that was kind of interesting because there actually are some industrial metals involved in precious metals, as it turns out.
I'm going against the company line here. I have a silicone ring here. Sorry.
Despicable.
Sorry. It's comfortable. It's breathable. It's
for all that working out you're doing, right?
Yeah, exactly. Yeah. When I play play sports, and it just became comfortable. And honestly, I went to put on I had a silver not too long ago, and it's like it just feels so weird now on that. So give
I
it a few
believe
years, Nick, you'll go on there, because
be interested.
my wife like reset her wedding ring, right, and all that, and then I downgraded to the $4 silicone
I love
ring.
it.
That's how it goes these days.
Very economical of you.
Yeah. Well, good stuff to hear on the rings.
So before we get into it, as we always do, got to show you the safe harbor provision. These are the opinions of Nick Webb, Mike Carrozzo. There are going to be some forward-looking statements, some opinions of Mike and mine. These are not the opinions of Ryerson; they're the opinion of he and I. So do your own research, do your own investment research. But we got some great content ahead, and as Mike had alluded to, this idea of this winter that may be coming. On the left-hand side, we've got a snippet from the article, but ultimately about probably 3 to 4 weeks ago, the CEO of the world's biggest steel mill, which is Baowu Steel, he came out and kind of issued this pretty harsh warning to, I don't know if he was doing it to his peers or to the entire global industry, but he basically said he's seeing things looking really, really soft within China. And it's kind of harkening back to some of the types of steel conditions we saw in not just 2015, but also 2008, which, for those who don't remember, that obviously both of those two time periods were pretty tough times for steel mill profitability. And you can see that evidenced over on the right-hand side. That's just a chart that I pulled from Bloomberg, where it's showing that basically Chinese steel mills are quite unprofitable right now, given where steel prices are relative to things like iron ore, energy costs, labor. So a lot of steel mills over there are losing money. I would say it's fairly tight margins for some of the mills in more of the Western world. But yeah, this caught a lot of commodity players by surprise, because it was so harshly bearish for specifically the Chinese industry.
Nick, how much does this go into? So for probably about a year and a half on Cup of Joe, we've been talking about the manufacturing activity in China really hasn't come back, right? After or we were waiting for some stimulus to come into China,
Sure.
and it never quite did, right? Or to the levels that they expected.
Yeah.
So could this be a direct impact from that? Could it be isolated to China?
Yeah, so I might answer the question by rewording it a little bit, which is, it actually looks like their manufacturing economy, their production of things like EVs and green energy and things like that, their infrastructure. Actually, those areas are doing pretty well. And if we take a look at this slide that I've got here, if you've got the visuals up, going left to right, you kind of have your situation of left-hand side. Their real estate sector is extremely weak. And unfortunately, the real estate sector makes up a very large percentage of the individual's net worth. It also makes up a very large component historically, of steel demand, rebar demand. Obviously, iron ore is going into that, and cement as well. So the real estate side of things is, negative 10% growth year over year. And as you can see, that's already on the back of pretty weak numbers for the last 2 years. I know we've talked about things like Evergrande, the big property developer in China that's just been struggling a whole lot over the last few years. That continues to rear its ugly head. But it does look like it's kind of a tale of two cities, where you've got, yes, the real estate side of things, both commercial and personal, is quite soft. And that I think is what's weighing on the steel industry. But then you've got the manufacturing side that's actually kind of on the opposite end, where it's growing by close to 10%. And then infrastructure is a little squishier, but 4 to 5%. I'd say that's in the range of where China overall would want the growth numbers to be. But it's just this pesky figure on the left, which is the real estate side of the economy, that's really weighing on steel markets.
Wow. So I know you mentioned that they're kind of equating it to 2008 and 2015. Do you see a big difference between now and those two leading
Well,
into
I think the
it?
biggest difference, I think the biggest difference for us here within North America, and maybe this is obvious, is just the fact that since 2015, when we did see very soft Chinese markets, and I've actually got a slide on this here in a few, is that we now have tariffs. We now have very, very substantial tariffs here within North America, that even if you do see a very weak Chinese steel market, a lot of it's kind of buffered off. It's not perfect. It's not going to wall every bit of weakness out of the market. But certainly, if we're trying to, look at sheet prices and determine whether or not their weaker sheet prices are going to have an impact on us, I'm going to say it's going to be much more muted in this present environment than it would have been in 2015, because that would have been prior to many of the tariffs that were announced that were actually intended to block off some of that weakness. But as you had mentioned, and we've talked about this slide in the past, which is China has historically been an economy of big money in, big money out. And again, this chart, as a reminder, is the Chinese credit impulse. So it's essentially how loose or how tight are their credit markets with regards to lending and putting credit in the system. And you can see that since COVID, we just haven't really seen that normal wave of big money in. And it really has been a waiting for Godot type situation where everybody's kind of on pins and needles in the commodities world saying, when's it going to happen? When are they finally going to, ignite their property sector and prop that up a bit? And they just have not done so yet. They're in the last couple of weeks, they announced a small stimulus that was, I think it was like $300 was supposed to help towards the purchase of an appliance for your home. Sounds somewhat meaningful, but I don't think that's the type of announcement that people were hoping, where it's like a broad, we're going to help people, purchase new places or prop the value of these places up. So this is one of the headwinds as well for China that's just not yet creating a spark for the steel industry that they've been hoping for. But this is kind of, they're going to look really busy, but I promise they aren't. What we've got here on the left-hand side versus the right-hand side, the left-hand side is going to be Chinese monthly steel export volumes. So this is steel that is leaving the country. Essentially the idea is if it's leaving the country, it's not being consumed by the local economy. It's an illusion, or it's an idea that the Chinese economy can't consume all that it's producing. In effect, it's overproduction, which could be a supply situation where they're just producing too much. Could be a demand situation where they aren't consuming as much. But nonetheless, if you're not consuming what you're producing domestically, it's going to leave your country. And as we sit here right now, when we look at the kind of sky blue line, that's going to be the current trend. And steel exports going out of that country are quite high. They're actually about 9.5 million tons per month, which, to annualize that figure, that puts you up like 114 million tons annualized. That's bigger than the United States steel industry overall. So that is just the amount that is leaving their country by way of exports. Now, again, it's likely not coming to the United States. It's likely not coming direct to North America, but this is going to feed into other Asian nations who may have their own domestic steel industries, and then they may be forced to find new homes for their oversupply or overcapacity. And all we're looking at in these charts is basically January through December of each year going back 10 years. So that's really what the data is within the charts. But again, harkening back to this comment by Baowu saying things are as bad as 2015, no coincidence, the last time we were at these types of levels of exports at this point in the year was 2015. So it is kind of rhyming a bit with what we would have seen back then. I've got another slide on steel prices for China here in a few that I think will perhaps shock some people. It sort of shocked me. But again, we'll talk through the ramifications of that. But I think it's important to note that while things are quite weak on the steel side, it's kind of the opposite when you look at, maybe, things like copper, things like aluminum, things that would be feeding into, as I referenced before, this really strong manufacturing sector, because their imports of copper ore and copper concentrates is actually right up near record highs. And again, it's the same chart. It's looking at the seasonal data over the last 10 years. And both last year and this year, Chinese copper concentrate imports are quite high. And so it does seem to be a tale of two different types of economies where, more their high tech, EV, green energy, infrastructure markets are actually looking pretty okay. It's just the fact that, a lot of the steel production that they've produced over the last 15, 20 years, it just seems like they've got too much of it. And, the unfortunate thing for them is I think the only real solution is you can either stimulate massive growth into the economy and put a whole lot of debt into the system and grow into that demand, or I apologize, grow into that supply, or you more likely got to shut down some of that excess production, because it seems as though they're producing too much steel and it's basically just getting exported out into the global economy.
So remind me, Nick, I know there's trade restrictions with North America, United States. Are there countries in that same boat? And the thing is that, right, if it does get exported to, let's say, Germany, right, and you buy it from there, and it's a or country of origin is China, we still can't bring it in. So I mean, that's got to create a big glut if they're
It, it,
exporting all
it
that.
certainly does. And yeah, so I mean, I know this phrase has been used a lot in the last few years, but it is kind of a game of whack-a-mole where yes, the US was kind of first to enact these tariffs and even build on these tariffs, but Europe's got their same setup where they're blocking a lot of the bad actors or what they view as bad actors in terms of dumping or oversupplying their own domestic markets. So Europe's got a lot of these policies in place as well. But
Mhm.
places that don't might be some of these Asian nations. And it's interesting to note that in the last couple of months, we're beginning to see countries like Vietnam start to take issue with the fact that all of these exports are flooding into their own market. They've got their own steel production there. So they're kind of getting undercut now. So it
Yeah.
looks like some of these other Asian nations are beginning to put up their own barriers to say, enough is enough. We need to slow this roll a little bit. So I think we're probably going to see continuation of that trend just because, these numbers again, while they may be relatively small for China, 9 million tons per month,
Yeah.
call it 114 over the course of a year. China is a billion plus million ton steel industry. So it's pseudo small potatoes for them, but it's extremely large for potatoes for every other region in the world.
Have you had a chance to talk with anybody? I mean, when the headline is right, the long, harsh winter and the big crisis, right? And is that more hyperbole right now, or is like how's the market reacting to that? I guess are they? I guess what
Yeah.
is it an overstatement?
Yeah, no, it might be a slight overstatement, but I do think there is going to be some pain to be had. I mean, I think when you work through these types of things, these companies run on a lot of debt. It takes a lot of capital to get a steel mill up and running and to keep it running. And so if the contemplation is should we bankrupt these companies, there's going to be some pain felt within the credit markets and financial markets broadly over there. So I think it is accurate to say that there's some real pain, and I do think some of this real pain does look similar to a 2015 type situation. I don't think, in comparing it to '08, I think a lot of times when you say '08, you start thinking about, the broader great financial crisis. And it doesn't appear as though it's going to have that kind of knock-on effect. I think this seems to be fairly steel centric. Um, Obviously there can be spillover and stuff, but as we show over on the right-hand chart here, it's not all industries that are
Mhm.
that are getting hit like this. It's primarily things that are going into property and infrastructure.
There's an interesting question here from one of our viewers, which is an interesting spin on the export, right? So might a country that can sell to the US, right? So in theory, they can buy that Chinese steel, keep it, and then export their own, right? So there could be a benefit
No,
to them?
absolutely,
Wow.
there could be,
Yeah.
and I think that may very well be happening. So
Yeah.
while we may have 500% tariffs on Chinese steel, if we only have, I'm just making up examples because I don't have all the numbers in front of me. If we have 30% tariffs on some other country in the region, they can take the cheap Chinese steel, use it for their own economy, and
Mhm.
then take their excess supply that th're now left with, sell it into North America, and there ends up being a 30% tariff instead of 500%. Yeah, I do think that game gets played. I do think that is a real thing, and that's
Yeah.
why this game of whack-a-mole really is applicable here because it then forces the United States to say, okay, how big of an ally are we with that nation? Do we want to punish them in this way by taking their tariff rate up to something closer to China's? So I would guess all these decisions are taking place out in DC for sure.
Interesting. Yeah. Well, big headline over the past few weeks, so we couldn't go too long without addressing that. So good stuff, Nick.
Yeah, absolutely. And on the same vein though, I think from a price perspective, I think this is a really interesting visual. So what this is doing, it's a normalized chart. So basically what it's doing is it's a 5-year chart. We start both points at 100. So price of copper and the price of steel. And over this 5-year time period, what you can see is from 2019 to 2022, I would actually argue there's a very strong correlation between the price performance of copper, which is shown in white, and then the price of Chinese hot roll, which is shown in blue. But since 2022, you can see the
divergence.
Yeah, the divergence just opening up
Mhm.
like an alligator jaw, and
Yeah.
Chinese steel prices are actually now down by 18% over this 5-year stretch, whereas copper prices are actually up by 56%. So there is a very clear divergence in terms of supply demand dynamics in different types of end markets. So I think this is a pretty interesting visual as well. So this is one of the charts that I referenced a few minutes ago, which is, and we look at this all the time, but what I wanted to do, I wanted to take the chart back a little bit further and look at Chinese prices as they relate to US prices and European prices, but look at it all the way back to 2015, because that was one of the dates that the Baowu CEO referenced in terms of this harsh winter. And Mike, you were asking the question, does it actually resemble a harsh winter? Does it actually resemble something like a 2015? And I would pretty confidently say that just eyeballing this chart, particularly the orange line, I would say, yeah, it does look somewhat similar. It may not be substantially worse, but it looks somewhat similar. We've got Chinese steel prices right now at $390 a short ton. It's kind of crazy to say, but Chinese prices at the end of 2015 were $250 a short ton, which for those who are keeping score, that's about $150 below where the price of scrap is.
Yeah.
That's the price of scrap to make steel in the United States. And Chinese prices at that last cycle were all the way down at $250, which meant that no steel mill anywhere in China was making money. You can't make money at that type of price level.
Yeah.
Now, that was the era when we started our protectionist regime and putting in place tariffs and things like that. And you can see the effect that it's had. It really has widened out that spread between where US prices ultimately sit and where Chinese prices sit. Do I think Chinese prices being as low as they are is going to be a headwind for US markets? I do. Even though we can't buy it, it's such a big player in the space, and those export numbers are so large. Again, they equate to the entire US steel industry is what they're exporting. It's got to weigh on how big this rally can ultimately be. But I will go on record to say I do think we have seen the bottom in steel prices for the time being. A couple of reasons why I think that is: one, I think there's an element of cost support that exists. When you think about where US scrap prices right around $400 for busheling scrap, we saw prices for a short period of time with a 5 handle. So that was meaning that electric arc furnace mills in the United States were not making a whole lot of money when you take scrap at 400, you do your processing to it and produce steel. Those margins got pretty tight. So I would say there was an argument to see some hikes. I think imports are on the decline just because, as you can see, when you compare US prices to European prices, that spread got pretty tight, meaning that there wasn't much of an arbitrage or a rationale to go out and buy foreign product. And then the third thing that we've got that we're actually in the midst of is there are a lot of outages that are expected to take place from the US steel mill industry. Many of those are planned. Many of those, commonly happen every year. But it is worth noting that earlier this morning, it sounds like Cleveland Cliffs is actually taking one of their maintenance outages, and they're going to extend it, I believe, indefinitely. And it's about 100,000 tons per year of production that they're essentially saying, market's a bit soft. We don't need this additional capacity right now. So they're actually, it sounds like once they finish that maintenance, they're just going to keep the facility down for some period of time. And I believe that's one of their Cleveland facilities. So those factors should help to put a bottom in. Now, the question is, how high do I think we go? Comparing, what I think may be a bottom over the last month or two to these prior couple cycles, where we very quickly got up to like $1,000 a ton, $1,000 per short ton. I don't think we're going to see anything like that at this present cycle. It just feels like the macro conditions are a bit softer. We've talked about how things are kind of cooling down with regards to the PMIs and with the unemployment picture. And I think those things are really going to take hold to just bring demand levels down incrementally. It's going to keep the market decently well supplied. So I would say I'm kind of picturing more of a range bound type market. I don't think we're going to take off until or unless somebody like China figures out their issues and actually figures out a way to support. I'd say rather figure out a way to curtail some of their production and take some of that excess capacity offline. I think that's the bigger, more just thing to do.
So is the bottom more of a producer controlled than it is supply demand?
I'd say it's a little bit of both. I'd say, yeah, you do have you have a factor of like that Cleveland Cliffs scenario where they took capacity offline. That should help from the supply side. I think from the demand side, we have heard of some industry players making some pretty sizable bulk purchases where, kind of an indication that they're bottom feeding a bit, doing some pretty bulky, chunky tons, and that helps to push lead times out temporarily. So I think it's a little bit from both sides, demand and supply. But the unfortunate thing is, somebody making a chunky buy because they think they're bottom fishing, that doesn't necessarily have to mean that demand is better. It just means that in the short term, it can push lead times out for a couple months.
And while we're on here with the global steel prices, kind of harkening back to our top story, our friend Jennifer Betts is watching. Hey, Jennifer. She sent out a question. Do you see a correlation between Chinese steel prices and an increase in consumer demand for more green steel products produced elsewhere? So the green movement and some of those types of materials, is that causing some of this panic, if you will?
I suppose, yeah, it could be. I'd say
Yep.
it certainly could be. I mean, I think when we go back to that chart and we look at, copper's performance relative to steel performance, I think there's absolutely a case to be made that things like copper and aluminum, which tend to be more correlated to lightweighting of vehicles or EVs. In the last week or two, BYD, which is the world's largest electric vehicle producer, they actually upped their forecast. So this is another example of like not all things are bad in China. They actually upped their forecast from 3.6 million vehicles annually to 4 million vehicles annually as their forecast. It's a pretty meaningful jump. And, there is a difference in the way that EVs tend to be made, which is more aluminum, more copper, more nickel, and less carbon steel. So yeah, that could incrementally be weighing on things. I can entertain that. Have I done the correlation on it? I haven't done any mathematical, stats models on it.
Could it also be in, is it Nucor that produces the greener carbon steel? And is it more on that? And like, does China have those in place? Sure, I don't know what I'm talking about there.
No, totally fair. So in China, I would say China seems to have a different environmental stance up to this point in time where, they're building a lot of coal plants. They're seemingly not going through the same climate related environmental changes that Western parts of the world are. So I don't think anything's meaningfully happening there. And even within the United States, even though there's a lot of rhetoric taking place around the green steel movement, from what I didn't get to attend the steel market update summit last week or 2 weeks ago, but from what I understand, based on the headlines, a lot of the commentary was that it's a lot more conjecture thus far, and not a whole lot of rubber meets the road in terms of consumption of that product yet. And I think there were even some participants who said they don't even think it warrants a higher price just yet until you really start seeing a demand rationale for it.
Makes sense. Okay.
As we often do, like to look at where steel futures are relative to where, if we take scrap futures and add on $250, again, this 250 is just a theoretical margin built on top of the cost structure of making steel. And what I would say is, at least in terms of the EAFs, the electric arc furnaces who make steel from scrap, looks like they're sitting in an area right now where, given where steel prices are, they should be making some money. Might be a slightly different case for the BOFs, and I think that may be why we saw Cliffs actually announce that closure of one of their facilities, because it's a little tighter on the margin side for them. But I think futures are in the realm of being somewhat fairly valued given where raw materials prices are. And while we're on the topic of raw materials, I would say both in the case of scrap as well as in the case of iron ore, we're seeing some pretty subdued pricing. So there isn't a real big cost push rationale for substantially higher prices at this point in time. When that Baowu Steel article came out, iron ore prices dropped pretty dramatically, and I think they're now trading right around $93, $94 per ton, which a couple months ago that would have been $110, $120. So some pretty meaningful degradation in the price of iron ore. And as you can see in this chart, we're really kind of troughing on most of the main grades of ferrous scrap here in North America. And I think the expectation for September is even a slight decline. I would say best case scenario, flat month over month, which again, I just feel like, there isn't a ton of rationale to support a $200, $300, $400 move higher in the price of steel in the coming months. So I'll probably just leave it
Yeah.
there. Perhaps what we can do in the next cup of Joe, my analyst and I, we've actually put together some analysis around, what metals sensitivity looks like to rate decreases. So I think that could be one that maybe is meaningful. That once we actually confirm that we get into a rate decreasing regime, what's that mean for metals, and we can talk through some of those aspects in next month's cup of Joe.
Yeah, I like that. That's really good. We can start talking about rate decreases.
Yeah, absolutely.
Um,
And maybe refinancing your home or something, right?
right. Yeah. I think I've mentioned we did a major renovation earlier this year, and just waiting for those rates to go down.
Yep. And you're not alone. I mean, that is truly where people do have a wait and see approach until or unless these things happen. So that is how it eventually feeds into the economy in a real world situation.
Yeah. All right. So what's the big takeaway?
2025? Yeah. No, I think as we sit here in September, we're mid-September already. I have no idea where this year has gone, but as we look forward to 2025, I think there's going to be some hurdles we got to get through here in the very near term. But I think as we look into 2025, there's a pretty interesting opportunity as we think about contracts into next year where prices. I'm not here to say we're at a bottom in a lot of these markets, but we're certainly seeing price levels that at this point in the year relative to the last couple of years for contract season, much more advantageous. And this is not advice to anybody to say you should lock up your prices, but I think we should at least have some conversations. So if you've got a Ryerson sales rep, get with them. They'll get with myself and my colleague, and we can have those discussions. But the good news for consumers is, a lot of this squishiness that we're seeing in the macro environment is creating a situation for softer metals prices for the time being. And who knows, that may not last for all that long. So we can at least have those discussions.
How's Ohio State looking this year?
Good.
Good.
Yeah. Man, the NIL money, I feel like, has created a couple like pseudo professional teams. And as an alumni, I'm a little sad about it because I like the purity of the sport and for college, that is. And I think we've lost a little bit of that, but I think they're going to be a good team this year.
Yeah. Yeah. It's hard to believe. And when college football started a few weeks ago and then the NFL last week, it like you said, where's the year gone? I just wasn't ready. All of a sudden Sunday came and football games were on, and I was like, wow, where did this all go?
You walk outside and you get that crisp air in your face and you're like, I kind of love it, kind of hate it.
Yeah. Because we're going near the harsh winter in a different way. But all right, Nick. So congrats once again, and we will talk next month.
I can't wait. Thank you, everyone.
Thanks all. Bye.